Here's a fact that sounds impossible until you understand it. The stock market, measured across any 20 or 30-year period in modern financial history, has gone up consistently, reliably, and significantly. The S&P 500 has returned an average of approximately 10% annually since its inception, surviving every recession, every crash, every financial crisis, and every period of geopolitical instability in modern history. And yet the average individual investor, according to decades of behavioral finance research, has consistently earned returns significantly below that, not because the market failed them, but because of what they did while the market was working. This is the central paradox of retail investing, and it has a name. The behavior gap is the measurable difference between what the market returns and what the average investor actually receives. And it exists almost entirely because of two instincts that feel completely rational in the moment and are almost always financially destructive in practice. The first is the instinct to sell when prices fall. The second is the instinct to buy when prices rise. Both feel like logical responses to market conditions. Both do the opposite of what compounding requires. Consider the mathematics of a single emotional decision during a market downturn. An investor holds a broad index fund worth $100,000. The market drops 30%, a significant but historically normal correction, and the investor sells, locking in a loss of $30,000 and moving to cash to wait for stability. The market recovers over the following 18 months, as it has done following every major correction in modern history. The investor, now waiting for the right moment to re-enter, misses the recovery entirely or re-enters late after prices have already climbed. The long-term compounding engine that would have rebuilt and grown that position automatically has been interrupted by two decisions that felt protective and cost everything they were trying to protect. Research from Dalbar, a financial services research firm, tracked this pattern across 30 years of market data and found that while the S&P 500 returned approximately 10% annually over that period, the average equity fund investor earned approximately 4% annually over the same period. That 6 percentage point gap, sustained over 30 years on $100,000, is the difference between approximately $17,000 and $1,700,000. The market produced the wealth. The behavior consumed it. The stock market does not lose money for most people by going down. It loses money for most people by going down in a way that triggers the exact psychological responses that turn temporary losses into permanent ones. The market is not the risk. The investor's response to the market is the risk.